Okay, fam, welcome back. So today we're going to be going over 6 core positions that we intend to invest in for the long term. So with that being said, let's get it. Okay, so what do I mean by 6 core positions? Basically, what I'm referring to here is dividend paying stocks or ETFs. I'm sure you guys can probably guess which ones they are based on the tabs up here. So the first thing I want to go over before we do that is I actually want to go over Tesla earnings. Again, we may or may not go deep into this in this video, but you can see clearly whatever happened with Tesla, the market absolutely loved it. So it's up 8.5%, which is good because I would say the market needed a lift after that hideous sell-off we just saw today. So actually, you know what? We can go ahead and take a look at this. I'm not sure if Seeking Alpha is actually going to let me look at this because I don't have a membership with them, but we'll maybe try to take a look anyways. So it said EPS came in basically above, analyst estimates, because that's pretty much what this is, a consensus of different analysts and kind of the average of what they expect. It says it was also up in quarter 2, and it says that GAAP net income for the quarter was $2.2 billion. Non-GAAP net income was $2.5 billion. So they're still making money. That's always a good sign. Says the operating margin was 10.8% of sales to improve from last quarter's mark of 6.3%. So it seems like there is improvements overall. And it also says that it disclosed 462,890 deliveries for Q3. It said that Tesla said that it would produce roughly about 470,000. So a little short on the mark, but I mean, based on what we're seeing here overall, I think it's conclusive that basically it pretty much more or less beat analysts' expectations. I mean, if it didn't, the reality is the stock would not be up a massive amount like this. And as you guys know, Tesla is extremely, extremely volatile. So if you have TSLY or TSLP or anything else Tesla related, you're probably shouting from the rooftops right now because your stock just skyrocketed to the moon. All right, so let's talk about these 6 positions. The first one I want to go over here is SPYT. Okay, so this is the Defiance ETF. It's like a target date fund of some kind. I don't know exactly how you would word this. It's income target ETF. Okay, so basically the objective here is for them to hit about 20% year over year income. That's pretty much the goal here, to aim to achieve a target annual income goal of 20% in the S&P 500 using options paid out monthly. You guys can go over the finite details on the website here if you want to look at it. One thing that I have noticed about this ETF is it does not have a whole lot of what people refer to as NAV erosion. There's the also NASDAQ version of this, the triple QTs, but we don't really see the point of having both. Since we plan on having GPIQ GPIQ, which is the NASDAQ version of the Goldman Sachs fund, we'll get into in a minute. But this one doesn't have a whole lot of NAV erosion or any at all compared to these other ones, which used to be known as triple QY and JEPY. Of course, the income for those do generally pay out more than the price drops, usually so long as the market conditions are good. But pretty much the synopsis here is it pays 20% per month. So the average payment per dividend is about 33 cents, as you guys can see here. So the overall goal with these 6 funds is to get to about $100 a month per position. Okay. So if we needed to get $100 per month from SPYT, we would need to own, I think, roughly about 350 shares, if I'm not mistaken. So, or not 350, my bad. I think it's actually about 300 per share, or 300 shares total is what we would need. So latest payment, 34 cents. Yeah, you can see that comes out to about 300. So it would be roughly about a $6,000 investment. Again, this would happen over time. Ideally, we would like to buy on the dips. The price on this one is not going to fluctuate a lot because it's kind of designed based on price action to pretty much sit at that $20 level. It's not really designed to have a whole lot of volatility, as I'm going to show you guys on the charts here. So yeah, you can see this since this thing's inception, it was opened up at $20.05, and it pretty much has stayed right around 20. It's slightly under that. you can see on those dips we had in the market. So in September, it did dip about $1. And in August, when we had that really crazy flash crash, it went down about $1.50. But if I were to compare this to some other things that dropped, I mean, the actual NASDAQ itself dropped more than this, okay? And again, I know this is not based on the NASDAQ, but I can just show you guys right here pretty much what that would look like. So if I take the measured move from, let's say, that kind of July swing high here to about the lows, which is apparently a lot deeper than I thought it was going to be, roughly about 11% here. Whereas if I measure the NASDAQ, the drop was absolutely bonkers. So this thing went down roughly about, I think it was about 17%. So it has more downside protection than the NASDAQ, and also the ES. I do actually want to measure this one because, again, this is what the actual fund is based on. Again, the triple QT is going to be based on the NASDAQ. This one will be based on the S&P 500. So 10%, 11%. Okay, so it did go down a little bit more, but the point I want to make about this is when it recovered pretty much all the way back up to its listing price. So there doesn't seem to be a whole lot of risk here. This is a relatively new fund. Again, it's not designed to appreciate in price, but it is designed to stay relatively flat over time and provide some nice juicy income. There are a lot of investors out there that look for things that go sideways and or slightly up, but pay pretty juicy income, something like maybe SVOL. So that would be the first one. The second one I want to look at here is GPIQ, GPIQ. So Goldman Sachs NASDAQ 100 Core Premium ETF, or Premium Income ETF. So it says it aims to generate a consistent monthly distribution rate, generally from options premiums and equity dividends. I'm not sure what that means. Maybe they have access to they have exposure to the underlying. I'm not sure. So it says it provides core equity exposure to the NASDAQ 100 index and dynamically sells call options, allowing for participation with rising markets and potential outperformance in negative to flat markets. So it sounds like they have some upside outperformance and downside protection. And it says diversifying source of income seeks to deliver attractive income with a lower correlation to traditional income sources and their risks. As you guys know, when volatility picks up in the market and the market screams to the upside or slams to the downside, it can be pretty scary, right? So if they're providing downside hedging and upside, a little bit more upside growth, that's always a plus for a dividend paying ETF. So the funds in this one are actually, they're decent size. I mean, they're not huge, but 233 million. It's nothing like GPI or GPIQ. I think those have like 10 or 15 billion or some crazy number like that. It's really a lot compared to something like this. But again, those funds have been around forever. This one's still relatively new. So in terms of and of course you can go to the Goldman Sachs website to look at all this stuff for yourself. They probably have a million other funds, I'm sure. So here's the distribution schedule. You can see as the price has risen with this, and I'm actually going to pull this up right now. So GPIQ, you can see the price since listing more or less has risen with the market. It should look pretty much the price action should look pretty much almost the same as the market. Yeah, you can see it's pretty much, I did not mean to do that. Okay, let's pull that back up. Yeah, so the price action looks pretty much the same. If you look left to right, you can see it pretty much goes up. GPIQ goes up when the NASDAQ goes up. It goes down when it goes down, and so on and so on. In terms of, we'll actually see what the downside protection is here, just so y'all know. So the actual NASDAQ during that August dump had about a 17.5% drop, which is kind of scary because during the C virus pandemic back in 2020 and in 2022, the NASDAQ went down about 35 to 40%. So GPIQ, it does appear, managed to, its maximum drawdown was roughly about 1% less than the actual NASDAQ, so that's good. Now, if I measure it on the flip side, we'll say from swing low to swing high here, you can see this move was roughly about 22.5%. for the actual NASDAQ. And again, I'm using the futures version. This is not the actual NASDAQ. But the futures version is essentially the same as the stock market. It's basically like it would be like an index fund for the actual stock market. Essentially, it's mirroring the price action of the stock market. That's what futures is. So a little bit less of a gainer here on GPIQ, but still nonetheless, there is some upside here, 15%. So the good thing to note about this is that GPIQ itself, since inception, of course, the market has to go up for this to go up, which it has. But since inception, it has had a pretty nice outperformance. It's been up as much as 23%, pretty much year to date, even though it was listed last year. And in terms of from inception to the peak, it was up about 27%. So you can see there's a lot of price appreciation here. So in terms of the dividends, pretty much about how many shares we would have to have, I think would be roughly 250 if I'm not mistaken, which is a decent amount. But again, $100 a month is a lot for dividends. So it's about 40, we'll just call it 47.5 times 250. So the initial capital here would need to be quite a bit. Of course, options will always help with that. And we do plan on having at least 5 contracts of, what is that thing called? Soxel. That's it. Okay, so next one on the list here is GPIX, which is the S&P version. Of course, we want to have some diversity because the S&P and the NASDAQ don't have all of the same stocks in it. The S&P has way more. The NASDAQ is more heavily weighted towards tech, naturally because of the weightings of the Mag 7, whereas the S&P is not. So basically what I'm saying by this is GPIX would be less volatile and pay out less income than GPIQ. But when you get a drawdown in GPIX, the drawdown should not be as significant as GPIQ. So GPIX, you can see it there. The dividends are roughly about 33 cents a month. Okay, so GPIX, this one has not pulled back as much as the NASDAQ. As you guys can see, the NASDAQ is kind of chopping sideways, whereas this one is actually pushing to new all-time highs. So it's up 24.5%. So that does kind of offset the slight reduction in dividends, the fact that this thing is likely, at least at this time, outperforming the NASDAQ 100. So in terms of, and once again, you can see on the dividends here, they do have slight increases over time. That is always a good sign. I know that's something that JEPI and JEPQ lovers really enjoy about their positions. So I'm trying to think of how many shares we would need. I think we would need about 300. So if I'm doing 300 here times 49, comes out to almost 15,000. Again, that's a lot, but there is some people out there that put like $20, $50, $100,000 or more into things like SCHD or Vanguard index funds or whatever, you name it. Okay, there's some people out there that have insane amounts of money in any of these given positions. So if you think that's a lot of money, it's really not. It's a lot for the everyday ordinary person, but for extremely wealthy people or accredited investors or institutions or whales, it's really not that much. Again, you got to understand when it comes to finance, there is levels to this thing. It's not just simply everyday ordinary people getting into these. There are people out there that have billions, hundreds of billions, millions, maybe even trillions of dollars that are doing this. So $100 a month, yeah, that would be about 300 shares. And the last three here is going to be QDTE, XDTE, and RDTE. We pretty much already hit our goal on the QDTE, so we just add to it or take profits along the way, depending on how the market does. In terms of the $100 a month, we're pretty much there. XDTE, we're about 80% of the way there. So this is QDTE. You can see the dividend payments over time has been very inconsistent, but we kind of figured as much. So we have 110 shares. And if it pays about 20 cents a month, 25 cents a month, somewhere in there, it should consistently reach roughly about that $100 mark. So you can see it right here. Yeah, so I mean, some weeks are going to be insane. You're going to get paid like 50, 60 cents a week. The other weeks you might not get paid hardly anything, maybe 15, 20 cents a week, and somewhere in between. Please do your own research on these, understand what you're getting into, take a look at the price over time, how these options within these funds are traded, all that kind of stuff, so you guys can understand in depth what you're getting into. You know how the old adage goes, never invest in anything that you don't understand, right? So XDTE, this one's a little bit less volatile, but the dividends are still pretty all over the place. So lowest payment ever was 2 cents, and then the highest payment was maybe, not sure, was it 41 cents? Yeah, it looks like it was 41 cents. So the average seems to be about 20, 25 cents, which is pretty good. I mean, that's per week. So you're getting about $1 a month in dividends per share, which again, to get to $100 a month would be about 100 shares. And the last one on the list, which we probably will end up owning, if we don't own this one, we may end up owning a different version of the Russell 2000, but that would be also RDTE. Again, this one is relatively new. The dividends are insane. I mean, this is really a lot. That's like $1.20, $1.30 per month per share. But the Russell 2000 usually outperforms around Q4 to Q1 of any given year, especially during bull market years. That's usually when the small caps start popping off. So let's take a look at the prices on these, or the price fluctuations on the actual funds. So RDTE has, since inception, it is up, but it's been kind of up and down. Again, this one's probably going to be a little bit more violent one way or the other in comparison to the NASDAQ or the S&P 500, because again, it is small caps. These things are very all over the place. Even during bull markets, they can be very all over the place. So it looks like it's maybe pulling back a little bit in comparison to the actual Russell 2000. So maybe if you are not comfortable with that, maybe the better option here would be the QDTE and XDTE or another Russell 2000 version. But again, we plan on having like 30 to 50, maybe even 100 different positions, paying somewhere between 5, 10, maybe 20,000 per month. So this would be a very small percentage of the overall portfolio ultimately. So in terms of the amount of money or the shares that would be needed to actually have $100 a month in this fund, it wouldn't be that much. I think it would be roughly about 80 shares, maybe even less than that. So only about $3,400 in total. So it is not really that much compared to GPIQ and GPIX. Whereas, which one is this? QDTE, yeah, this one has not gone back up to its previous all-time high. Again, the NASDAQ is not at the all-time high, so that shouldn't be that shocking. This thing did post a listing 46, so it is down since then. But again, as long as the market is down, this thing's not going to go up. So, of course, we already know that after it has dipped, it does have the ability to also increase in price again. So that's something to look out for. If the NASDAQ starts shooting up to all-time highs, I suspect this thing will go back to all-time highs. It's just a matter of time before it happens. Because, again, if it did it once, it can do it twice, right? If it went back up to highs once, it can do it a second time. And XDTE is a little bit more stable. I'd say it's probably the more stable of the three. Again, we had this crazy August flash crash, went all the way back up to 52.60, which is still above the listing price. And as of right now, we are also still above the listing price. All right. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.